am Julia Cordova, and welcome to the Place Your Trades Network. We are the network that focuses on trading daily options using CME Group's event contracts to trade E-mini S&P, NASDAQ, Dow, Russell 2000, gold, silver, euro, crude oil, natural gas, and copper. We have a fantastical show for you today. I'm going to be talking to James Stanley. He is one of my favorite follows. We're going to get you prepared for all of the volatility in the week ahead and just talk about volatility in general. Today's broadcast is brought to you by Tradeovate, which has built a custom app dedicated to trading CME Group's event contracts. That's what we're all using at Place Your Trades. Over the next month, we are giving away a trip to Las Vegas. One winner will join the PYT team at the Money Show on April 24th to April 26th. All you have to do is go to placeyourtrades.com/Vegas and sign up before March 1st. On March 1st at 4 Eastern time, we will have a special show for you and we will spin the wheel to see who wins the trip to Las Vegas. I'm looking forward to it. I've not been to Vegas in a very long time. I feel like I'm at Vegas every single day when I trade. We are at a very critical spot in the market right now. If you are looking at the chat in the Place Your Trades live room, Pax just posted, we are back testing the 200 daily moving average on the NQ. I have a level right at it as well. Just be aware of that as we go through the show. Hi, James.
Hello. Hi, Julia. How are you today?
I'm fantastic. Thank you for joining me. I really appreciate it. You are one of my new favorite follows.
Awesome. Thank you. I appreciate that.
Somebody tagged me in one of your tweets. I think it was about gold. And I looked at your content. I was like, well, hello, new best friend. I think I'm going to this guy and like really pay attention to what he has to say. I love your work. I'm very excited about talking to you, understanding, your weekly preparation for most weeks, this week in particular, because it's already lit.
It's a huge one. On the desk, we always call this alphabet soup because FOMC, BOE, ECB, NFP, and then you throw on earnings on top of that. I feel bad for new retail traders, honestly. During these weeks, it's kind of like pace yourself, guys. You don't have to do it all at once. I think it's good in like a strategy perspective because if, for instance, I wanted to avoid some of that headline risk, it's easy to just keep things light this week. Let everything kind of play out. That Friday afternoon is probably going to be pretty awesome. I mean, I think there's a good chance that by the time we get to Friday afternoon, things are a little bit more calm. At that point, it's kind of like you're home free. You can start analyzing, weekly charts again, trying to get your sets off of, big picture levels. Hopefully that's what we're looking at. And it's not one of those, Friday melt up or melt down sessions where everybody's just trying to get squared up by the end of the week.
It's almost like they planned it to screw us, so to speak. I mean, why would they have 35% of the earnings, the net, what market is happening on the same week as the Fed? What are you doing? Do they plan that, or is it just?
No, I think it's just dumb luck, so to speak. It's kind of asking us last year because what are they doing with the CPI release on a Tuesday, FOMC rate decision on a Wednesday? That really sets up for a dizzying array of drivers. It's one of those things where they just kind of dumb lucked into it as opposed to planned anything. As traders, we have to adjust, we have to adapt, figure out a way to work with that kind of that rampant volatility or avoid it. I think those are the only two real options.
How do you set up for trading a week like this? I do channels and levels, and then I confer with people who also do order flow and who do Elliott wave, and I have all sorts of things that I looked for. How are you prepared for this week?
So for weekly preparation, it's going to come off monthly and weekly charts. I want to find the big levels. The big thing for me is a weekly or a daily candle close through that level. That to me says a lot about what is going on in that market. I'm generally going to try to read order flow via price action. Now, the downside is if I'm drawing off weekly and daily, there's not going to be a lot of signals or a lot of setups that I get to take. So if I want more signals, I got to go shorter term, and then I can work within the confines of the levels that I'm looking at on a daily and a weekly, triggering off a 2 or a 4 hour chart, essentially trying to get even tighter stop by going down a little bit shorter term. I tweeted this chart a little earlier. It was just bizarre to look at Fed meetings last year because, last year the Fed was delivering a really hawkish message. We came into 2022 expecting 2 or 3 hikes, and we ended up getting much more, and the Fed really had to kind of lay the groundwork for that. But if you look at performance in the 2 weeks after a Fed meeting, I think there was only 2 last year out of 8 where stocks were pretty bearish after the rate decision, And the big one was June, because June we got the 75 bip hike. You know, that was the first 75 pip hike. I think it was like a 40 years or something. But if you remember, it was Nick Timiraos had that article on Monday. The meeting was on Wednesday. Fed's in a blackout. They're not supposed to be talking to anybody, you know? It's supposed to be, you know, silence on that front. But yet Nick Timiraos has this, you know, really well-placed source at the Fed, says they're going to do 75. Markets freak out for a little bit, of course, because they're going to get a 75 pip hike. But by the time we get to the rate decision, the freakout's already done. And we got support, I think it was a day later, and then stocks ripped for 2 months until, you know, Powell had to do what he did at Jackson Hole. So I don't think he's going to start a forest fire unless he has to. And so that's why I think stocks are not in a terrible position for this week. I think the bigger factor is going to be once we see inflation data continuing to, or starting to surprise on the upside again. If that happens, I think that's where things become problematic.
I mean, I'm kind of the belief that price action is going to do what it's going to do no matter what. If he sends it down, maybe earnings send it up, or vice versa. You know, I don't know. But do you think that before he releases the speech, because it's gobbledygook to me, do you think that he does like a word cloud? Because it's right. Algorithms that are trading it, not people like me, right? Yeah. So algorithms have to take that gobbledygook that he says and turn it into tradable activity. Is there some study out? There must be, right?
I agree with you. I think, you know, I'll put this down to probabilities. I think about 80% of a market move is going to be because of what the market is doing already. But with that said, Powell can come out and be super effusive to change the script. And that's kind of what we had around Jackson Hole last August. We knew that going in, stocks were getting insanely expensive again. What was insane to me when looking at S&P performance after FOMC rate decisions last year was how reversals would show. So if Powell was delivering a hawkish message, say like the January meeting, stocks would tank. And then after the meeting, they would rally. You know, they would actually rip. Actually, it was January 26th, if memory serves. They tanked, and then they rallied after the meeting. It was almost as if Powell kind of soothed their nerves a little bit. I remember Janet Yellen had a comment, but she said something along the lines of, if we talk about a panic or a recession, then people are going to act as if there is one. We create that reality by even mentioning it. So the Fed is actively engaged in game theory here.
You also mentioned, you know, looking for the candles to close above a certain level. And everybody's got their downtrend line drawn a little differently. You know, we're all kind of,
right.
But me in general, I'm somebody who very much believes in the wait for the candle to close before you call it. And last week was the close above, I think, any way you can draw it. We broke out last week, and I had my own thing where I was looking at an old gap at 4076 that we closed above, and I was like, all right, well, you know what? Then for me, this is a breakout. Now, if we go back down and close back down in it, that's a fake breakout. We don't even need to close higher than we closed last week. We just need to maintain the breakout line.
Absolutely.
So we could actually close this week lower and still technically be broken out. It's possible.
It's so crazy because if you look at it fundamentally, you know, and I've been doing this since 99. I got into this because of the tech stock boom. So when I was seeing the retail mania in 2020, it was cool because it was the first time I actually saw something that was similar to what got me into this whole thing. It was like pure unbridled mania. You knew it was mania when you were looking at it. When you're seeing these made up, you know, token coins yielding 15% APR, you know something's off, you know? I mean, you really see people kind of throwing away the fundamentals. In many ways, it's Fed fueled, you know? I mean, ever since the Federal Reserve figured out that they keep bond yields low by doing QE, they're gonna prime the pump. And it's almost as if they got a little bit ahead of themselves with the whole COVID stimulus, but it's really hard for me to imagine a Federal Reserve that's going to stick to the line to QT, rate hikes, tighter policy for more than a couple of years. It really seems as though they just want to get to that space where they can pump again. And I think that's what markets are looking at. It's the nastiest fundamental environment I've seen in my career, where pretty much the worst thing you want as a central banker is, you know, 7%, 8% inflation when you're going into a recessionary environment. And that's what they have in the UK right now. I mean, they got 10% inflation in the UK and Europe. It's not looking good next 6 months to a year out. Yet, if you look at European equities, they've been flying. I think it makes it dizzying to a retail trader because the logic doesn't fit. You know, the fundamental backdrops, especially with rates higher, says the stock should be lower, but, you know, they're not really. I think what a lot of people miss is stocks don't generally bottom until like 18 months after the central bank starts cutting rates. Rate hikes can slow business down. They can kind of gird the runway, but they don't usually directly lead to collapse. those happen because of the knock-on effects of higher rates. Higher rates create reverberations, and then those reverberations lead into some unknown thing happening. We haven't seen that.
I mean, how many of these things can we possibly have? I remember the whole like China, I'm going to say evergreen. That might be the wrong ever. It
Evergreen.
was ever clear, evergreen, ever that was supposed to be the end. And it's like, no, it's not. And then this crypto thing, it just seems like there's just it's going to be something stupid in the end. And it's not actually going to be that thing. It will be the amalgamation of all the things. That was actually a great opportunity to buy.
100%. And that's really one of the reasons that I follow price action. It's like chasing your tail in a lot of ways. And the reason for something happening is far less important than it actually happening. And price action is usually going to get me in on that relatively early. I think this week is so loaded because, we're going to get through the Fed on Wednesday. And again, I think Powell's going to kind of, I think he's going to try to hold the line. He's not going to try to say anything too effusive in either direction. No SEP. The SEP's in March. So I think it's just even more reason to not create a forest fire here. But ECB on Thursday morning, BOE on Thursday morning, those two, I think could end up being more pertinent for the dollar this week than even the Fed. And then I think the dollar's performance could be very pertinent to stocks. So one of those weird relationships.
Oh, well, okay. Speaking of that, though, what do you think about metals?
Yes. So mirror image of the dollar. I'm basically trying to get a capitulation high on gold so that I could look to play a reversal off of it.
Yeah, I think we might get a surge higher this week that would then be potentially get a move down. I'm looking for a whoop, and then we'll see what happens. But it could even get all the way to 2000. It's possible.
One of the big things that I do a lot of is Fibonacci, and I use Fibonacci in some unique ways. I'll do a lot of Fibonacci retracement off of longer term levels. I really want to try to get a market intent. In gold, there's a Fibonacci retracement you could draw, and it's basically going through the Fed's last cutting cycle. So it takes the low in August of 18 and then draw it up to the high in 2020. The 50% mark is a really big deal on a Fibonacci retracement. The closed body candle through the 50 kind of invalidates the move, shows you the reversal or the move itself is being priced out. But the 50% mark of that move is at 1628. And that came into play September 26th, 27th, and 28th. I mean, a beautiful three-body sequence. The first body bearish, sends it down. It gets a wick reaction off the level. Next candle, it starts there, bounces up. Not quite an inverted hammer, but it's kind of similar to it. Then the third body, bullish engulf, is a full throttle move off of that support level. So it's really good indication that support was getting some respect. It was back into play almost a month later, October 21st. This time it actually got violated a little bit, and then it got violated a little bit more on November 3rd. But again, no closed body candles through that Fibonacci level at 1628. And then that helped to build a falling wedge formation. The falling wedge broke a week later, and it has been all upside ever since. The trend in gold is getting very parabolic at this point. This isn't something that I want to stand in front of directly. I never want to fade a direct breakout. I'm okay with giving up the absolute top or the absolute bottom. If you have higher volatility, your batting average is going to go down. The range of outcomes goes up. Your odds of getting on the right side of a trade, much lower, which stinks, but you could live with that. You could adapt to that as a trader. You have to get bigger wins, though. And that's what I think chops up so many retail traders when we get into these environments, because it's harder to hold the line when you have a winning position, especially when you just took 3 losers. But that one winner, it has to pay for more losers than it would otherwise, because volatility levels are higher. Your odds of getting on the right side of trade are lower. The ones that you do hit to pay for those that don't. So by and large, if somebody asks me, how should I play this week? I tell them, if you don't know, you probably shouldn't. But the breakout that we have in gold has been really parabolic. I'm just taking that off like the November 25th low connected to the December 29th low. That really highlights, a really strong upside trend. If you pull that back to the weekly, it's not quite straight up, but that's about a 120-degree angle. Definitely. Even recently, price has been leaving off of that trend. It's leapt off. It hasn't returned to that trend line in a while. Right now, price is building a rising wedge formation, which are usually pretty good for reversals. The big level that just does not want to give way is 1923.7. That level is it's singed in my memory.
I have 1926.1. Close enough, but yes.
It singed my memory so much because I remember for years thinking, is gold ever going to get 2K? There's no way it gets 2K. I remember looking at that 1923 spot and thinking, what the hell is going on in the world when that happens? Sure enough, 2020 happened, all the COVID stimulus, and we ended up getting 2K with ease. I do think gold is nearing a spot where it's going to top. Getting back to that Fibonacci retracement, the level itself is 1628. The 38.2 of that study is at 1737. It had really good play on the way up. So that kind of like confirms that others are looking at that level. It kind of highlights that we're going to see some continued defense here. That 1923 spot 7 level is still holding the lows. It had another support test on Friday. It doesn't look like it's done yet, but I have a fib at 1970. That seems like it could be an area for a capitulation high. But I think you hit the nail on the head with 2K. It might be. If it gets 2001 cent, who's going to buy that?
No one.
I don't want to buy it. Yeah, exactly. That's one of the reasons the cycle levels can work so well for trading reversal strats.
It'll go just a little bit above. It'll either whiff that big level or it'll go just enough above to trigger some people's stops, that might be.
Wants to get the stops for sure.
I hope it's this week.
If you're a market, it could be. I mean, it really could. It basically need Powell to dove it up, which, I mean, it's possible. You could see that quick break with that capitulation low in the dollar. It could be one of those things where maybe Powell doves it up, we get that quick capitulation low, and then we get ECB BOE the next morning. And, the ECB especially kind of has their work cut out for him because Lagarde hasn't had a ton of success and being super hawkish. I think in a lot of regards, markets expect her to kind of always lean dovish, even if she's being hawkish or saying something very hawkish. That scenario is possible. For me, that's what makes these weeks awesome. There is a high expectation for some pretty considerable volatility. And in my mind, at least, I know what to do with it. I know how to work with it. More volatility to me is generally a good thing. I know it could be frustrating for a lot of folks because the batting average is going to go down. If you're not cool with a 25 or 30% batting average, it could be a really rough week. It really comes down to risk reward, laying the setups incorrectly and sticking to your guns. I think that's where a lot of retail folks get really flipped upside down in these types of spots because they'll eat a stop, they're watching it, and then they'll go in and they'll do something that they shouldn't do. They take a couple of hits and they think, oh, well, this fourth trade, this fifth trade, it should work out. They over lever it, or they just take standard trade size into a FOMC rate decision where things are all up in the air. And when we have more fundamental drive, my analysis is worth less. It's less valuable because there's more what if, there's more unknowns that are on the horizon. And so I try to account for that the best that I can. The game for me is pretty similar. And then I'm looking for ways to get cheap risk.
How do you think the zero DTEs are affecting the volatility? What is happening there? That's going to be off the charts as well, right?
Yeah. I can't even look at VIX anymore. I mean, VIX to me VIX seems worthless to me anymore. I used to be able to use VIX as a pretty good barometer of how to position around an equity move. There are so many derivative products off of VIX any longer that I have a hard time believing that it is a great manifestation of volatility levels in a market. I was actually reading something a little earlier in Financial Times. I didn't get through the full article, but it said something like VIX is broken. It really seems as though that's the case where we've seen so much financial engineering. A lot of what we knew to be true just 5 years ago isn't necessarily true today. I do have a theory on the zero DTEs. It's a theory. If you look at the equity move that we've seen in stocks, it's the moves higher, the part you really want to be on. These short squeezes have been amazing. Basically, retail is trying to trade a collapse by, loading up zero DTEs that essentially become worthless within 4 days. The definition of zero DTE, something within like 5 days or something within that week. I'm trading zero DTEs myself. Honestly, if I go back 5 years and tell myself that I was trading an option that had 2 days to expiry, I wouldn't believe you.
I have to say, I did not expect to love trading the event contracts as much as I love trading them.
Right?
It's so fun. And
absolutely
it gets the degenerate going in me. Like if I have a swing going, but I think something's moving against me, I'll trade against myself in that snaps up and down. But I freaking love trading them. It's addictive and it's good.
I know Place Your Trade has the Vegas promotion that they're doing now. I actually just went to Vegas for the first time in years, a couple of months back. And I don't gamble. And I don't gamble because I trade.
That's how I feel.
It's kind of weird.
I'm like, it's enough. I get enough endorphins and serotonin.
But legitimately, if I look at an option with 2-3 days expiry, a zero DTE itself, I have a hard time with that because that option is going to be worthless into the day. I can't even conceptualize the theta decay on that. I'm not going to set in this thing for more than an hour or two. If I have, S&P at a decent level, if I'm going to swing it, I mean, I could take on a relatively light amount of risk by doing that through a short dated option. And I can get really good run if that reversal holds. My numbers are going to work beautifully if that play hits. And if it doesn't, I got premium. That's the risk. I don't have to worry about getting gapped against my stop or slipped on my stop. What I think's not really getting enough credit is how much hedge fund and institutional activity is going into these. I really do think you got a lot of professional traders that are doing a lot in these short dated options. Last year is not the type of year where retail is going to do very well. But those option volumes are just going up, up, up. I don't think it's retail that's doing it. I think you're getting a lot of institutional flow, a lot of hedge funds that are doing it because,
Are they,
you know,
are
you
they
got a lot
allowed?
of, yeah.
I guess they are.
I mean, it's a ready market for sure.
That seems
Yeah.
very
I mean,
risky.
there's, you know, a lot of interesting stuff you can do from a financial engineering standpoint. And that's one of the things that high rates kind of obfuscates a little bit because once rates are higher, you know, your opportunity cost on cash balances is also higher. If I'm trading a fund, one of the best ways to get, you know, short-term momentum, short-term volatility is in those short-dated options. The theta decay is insane if you're talking about less than a week, but if you're a short-term trader, it's not the worst idea in the world, at least in my opinion.
It's hard. It's that if you trade against yourself, it could be a hedge. You know, like
it could, for sure.
There's ways to do it for sure that I didn't expect.
My theory on this, and it's a little grandiose, I haven't completely worked it out. It's basically gamma squeezes. You know, we get markets going heavily short. You see put call blown out, you know, right when the S&P is at a low. That's a tough spot to try to get short in stocks. So you see dealers push stocks higher, capture that premium. And then before you know it, you got a bullish uptrend. Retail's jumping on the long side of this thing. And then you get a 2-month rally like we had, you know, from June into August last year. What happens when we get to a point where there is one of those oh no factors coming out there? You have a market that's heavily net short, you know, put calls blown out, and then, you know, as opposed to, you know, dealers being able to push price up to capture that premium, there's something that, you know, brings more selling into the market. It could equate to a really bad day. So much derivative exposure can be very difficult to conceptualize how much risk is actually there.
Do you have any opinion on the energy space?
I look at crude from a long-term perspective. I do a lot of work with macro. Right now with crude, I kind of see it as fundamentally bullish. The main reason being the U.S. is going to have to restock that SPR. They've already put the price out there that they want to do it, which kind of adds like a theoretical floor. You look at the WTI chart, so just ticker symbol CL, and go out to say like a monthly. The level of 75 is massive. It was resistance back in 06. It came into support in 2011. Was resistance again in 2018, 2019, well, 2018, before we had that, you know, the big collapse. And it came back in as resistance. It was summer of 2021. More importantly, though, if you look at that off the monthly, 4 of the past 5 months have seen an interaction at that level. You know, that seems to be the level that's being defended. Not the ultimate level, because we've had a couple of breaches, but there's been no closed body wicks off the monthly through that price. Go down weekly, you know, weekly, it's a little dirtier, but from the weekly, there's a falling wedge, which basically kind of shows how that support was playing in. You know, we had the low in September. It was close to 75, not quite there. And then we had that dig into 75 in like November, December. That lower trend line, upper trend line gives a really nice little falling wedge formation. Price started to leave that a couple of weeks ago. So timing this is going to be tough. Like, I don't know that this is the break because we're not getting a lot of run off that wedge yet. But 75 seems like the level to defend. What I need to see now is I need to see a push above 83. And that's kind of been my tell level for a little while because that was the lower high before we had that pierce below 75. So what I need to see at some point this week, well, some point in the next month, I need to see price break above 83.15 to give me some type of idea that this might have bottomed.
No, this brings the point home you were saying before. If it is bullish, then it's not like, who cares if you get in at 77 versus 83? No one cares if it hits triple digits. Right. So I think waiting for confirmation on that one that's what I'm doing. Listen, oil, you are guilty until proven innocent.
So you had an awesome point there about like not getting the absolute high or not getting the absolute low. Is volatility really good for traders?
Right. I
thought about that a lot because in what I do, it's really important to me to be just straight up and direct with people about this stuff. Because if you look at on Twitter, there's so many like furus out there, people that are trying to talk their book or a vanity exercise, so to speak. And I keep my tweets pretty plain Jane vanilla, just happy to share setups and, you know, the stuff that I'm trading. But regarding the question, is volatility good for traders? When I was at Daily Effects, we did a study on this and we took like 12 million trades, real trades from actual traders, anonymized data. So we didn't like know who was who. It's just anonymous 12 million real actual trades. And the craziest thing from that study was the winning percentages. In all but one currency pair, it was over 50%. The shocking thing was the more volatile the currency pair, the higher the winning percentage. The more volatile the currency pair, the higher the winning percentage. So pound yen is in FX or in Forex, probably one of the more volatile ones out there. And in the study, retail traders won 66% of the time on it, 2 out of 3. But they still lost on net because the average loss was 122 pips. The average gain was 52. So, I mean, you can just do a 3-trade sequence, you know, 2 wins at 52, that's 104 pips gained. one loss at 122 at negative 18 pip expectation over a 3-trade sequence. It's risk reward that's the undoing of most retail traders. It's losing $2 for every $1 they make when they're right, to the point where they could be right 2 out of 3 times and still be losing money. That to me was just mind-boggling. And I chewed on that for a solid year or so before I started like writing any content around or talking about it. I had all kinds of different kind of assertions that I'd made off that data study, but it held across the board. My main takeaway from this was, trying to figure out ways to get people to look at risk from a cost outlay perspective, treating trading like a business and not like an art. Well, I could buy support for $1 here, and maybe it doesn't work, but if it doesn't, I lose $1. But if it does, I can make 4 or 5. And so that kind of goes back to a question you asked me a little earlier about candle closes. If I want to trade a support level, I need some type of indication that support level might work. And the only way I can get that is a closed body wick. If I get a closed body wick, then I could imagine, well, hey, maybe I'm not the only one that's, say, following 2K on gold. We get a closed body wick, going through 2K on gold. We have a pretty good idea that sellers reacted there. Maybe it holds, maybe it doesn't. But I know exactly where I want to put my stop. And if this thing peels lower, awesome. I can look for 3 or 4 times my outlay. And if it doesn't, I lose $1. So from that perspective, trading kind of becomes fun, right? It becomes less daunting because you're not worried about tap dancing through Jerome Powell's speech. It's look at a closed candle, place the stop below. Maybe Powell can help me. Maybe he hurts me. But, I'll find out when that next candle closes, and then I'll react appropriately. That goes right to not trying to get the exact top or the exact bottom of a given move. Yeah. I call these decision windows with traders. Yeah. It's something that I've taught for a while. I call it the 4-hour trader. It's really pretty simple. And FX and futures, the 4-hour chart is really very valuable because it's like a session chart. You get like 2 bars per session. But that 4-hour chart's usually pretty consistent. If I could get a wick through one of my good support levels on that H4 chart, I usually feel pretty good about trying to play a swing off of it. If I set it up this way, where, basically in a given day, there's 6 4-hour candles. Reasonably, I could get 4 of those, because I have to sleep at some point, but I could get 4 of those in a day. If I just take 10 minutes at the close of each 4-hour candle, that's just like 40 minutes a day. In a week, 40 minutes a day over 5 days, 240 minutes. Add another 40 minutes of just general charting time. And so like in 4 hours a week, you could run a swing trader strategy, just looking at those candle closes and reacting then and there. Play stops, look at it 4 hours later, and don't track it too heavily.
I have loved speaking with you today. This has been just
thank you,
eye-opening and fascinating from my perspective. I really appreciate it. We covered the gamut. We covered the industries, we covered the metals, we covered energy.
I just really appreciate the opportunity. I mean, this was a lot of fun. So I love talking markets, and for basically the last 13 years, I've worked for Daily FX. That was writing and and communicating about markets. I hate to admit it, but it really kind of became a crutch for me. I started trading in '99, and I was just basically a system guy, more or less. I had a very simple system that I would follow and track, and I didn't really have to think too much about it. It was essentially just follow the system. And then when the system messes up, correct the system. When I got into discretionary stuff or more discretionary stuff around 09, 10, I really learned to kind of lean on writing and communicating as a way to kind of get clarity in my thoughts and what I'm looking to do. So I guess in a lot of ways, I've just kind of been doing my own work in Daily Effects, just writing and using that to better discover how I want to engage with markets. So any of these opportunities are just awesome because I love talking markets, love new venues, really enjoy getting to meet you and talk markets with you over Twitter. It's been fantastic. It's been awesome.
I really would recommend following James. He's just an incredible trader. I really respect your work. I love your charts. I love the way you think.
Likewise.
And now having had the conversation, I think we have some overlap. We're like a Venn diagram, just a little bit. Don't be offended.
Oh, a lot. No. There's a lot. There's a ton of there's a ton of overlap. And I think one of the things that I think is so awesome about you is that you came to the same place just in a different way. And ultimately we got to the same place. There's a lot of different ways to do this stuff. If you look at it big picture, there's really only one way to look at it, which is you're not predicting. The more impactful stuff, people don't really want to hear about. Like talking about trade and risk management or money management. Like I'll put out, like, oh, this is at a resistance level. And then somebody say, oh, it's going to blow right through that. Maybe it does. Maybe it doesn't. I don't care. The point of that resistance level is there's an area I can risk $1 to try to make 2 or 3.
Right.
And so maybe it holds, maybe it doesn't. I'm not trying to play the prediction game here. I'm just looking to run my probabilities. And a good resistance level with a closed body wick or a closed wick, confirming that it was, a reaction, that's valuable. And I think ultimately all traders will have to go that way if they do want to see success, because playing this game off a winning percentage alone is very tough. Goes right back to that Wall Street adage of picking up pennies in front of the steamroller. It might feel real good to have an 80% winning percentage, but when one of those trades is going to wipe out 10 good trades, you're really just kind of on a treadmill, you're going nowhere fast.
Thank you for making the time. I appreciate it, James. And I can't wait to follow you as you move on to new adventures.
Absolutely.
So bye-bye, James. I'm going to talk about event contracts now. I'll talk about the market a little bit, because if you were in that PYT chat, you saw Pax talk about that. I mentioned at the beginning of the program, I was like, people are going to be mad at me if I don't tell them that we're at one of my levels. That happens to coincide with the 200 MA on the NASDAQ. So we've got a little bit of a bounce so far. Will we hold it? This is what the app looks like that I have on my phone. You can take the trades there. And I would encourage you to click around the site, because there's actually some really cool picks that Pax makes in the morning. There's a strat pick, there's the poll, and then there's some statistics that I'm going to potentially talk about next week that are quant statistics. I super appreciate your time today. I hope it was valuable to you. I learned a lot. Take care. Follow James and me and Place Your Trades on Twitter if you don't mind. They're all good accounts in my opinion. Bye, everybody.